I think increasingly the demographics are in our favor. Though recently there are some articles talking about the demographic cliff for India also, but that's 20, 30 years down the line, right? So we still have a good runway of 20 to 30 years where we'll have superior demographics versus the rest of the world.
Welcome to Learn from Masters, the podcast where we decode the strategies of the sharpest minds in investing. Today, we are joined by Mihir Vora, Chief Investment Officer at Trust Asset Management. In this episode, we are moving beyond the textbook. Mihir is here to help us understand the why behind successful investing. We will be diving into how to apply disciplined research to your own financial decisions, how to spot the difference between the market trend and the true asset class shift, and the mental frameworks needed to stay the course when the markets get volatile. Mihir's insights into market cycles and risk management are going to change the way you think about your money. We are delighted to have him on the show today. Welcome, Mihir. You've handled funds across mutual funds, life insurance, as well as sovereign funds. I mean, what has this journey taught you about investing?
Sure. So first of all, thanks for having me. A pleasure to meet you after so long.
It's our pleasure.
There are some things which are common across investors and some things which are different in different institutions. For example, a retail investor wants the best of both worlds. He wants absolute returns in a down market.
Right.
And he wants relative returns versus benchmark and peer group in an up market. Institutional investors, of course, like a sovereign wealth fund, tend to be more benchmark driven, more professional about it, so to say. But ultimately, what I realize is that you can't be everything to everyone.
Yeah.
Right.
You can't please everyone.
You can't please everyone all the time. So you have to be clear about what you stand for as an investor or as a fund manager, what your investing philosophy is, and stick to it. And be confident about the fact that it works in the long term. And it's not going to work every month, every quarter. But as long as you've proven yourself over the long term that this works and generates absolute and relative performance over a long period of time, you should stick to what you stand for in your core investment belief.
Okay. And what I noticed is you're known to identify gorilla companies. And just to explain to viewers, gorilla companies are market leaders with immense pricing power. So can you throw more light on this and elaborate?
Sure. This is a topic very close to my heart.
Right.
And this is what actually we at Trust Mutual Fund stand for, which is our core investment philosophy of terminal value investing.
Okay.
Right. So just to spend a couple of minutes on it, India is a growth market, right? And we've seen that in an emerging growth market, there are always new stocks, new segments or sub-segments emerging, which then have a long runway of growth, which don't grow for 1, 2, 3 years. But we have seen, many sectors when they emerge, they grow for 10 years, 20 years at very high growth rates.
Right.
Or if not segments, even companies, right?
And what's basically happening now to the e-commerce and the platform companies? Yeah.
Or what we saw, for example, in the first set of private banks, which came 20 years ago, 5 years ago, they grew for so long. Then you had telecom companies which grew for so long. You had IT companies which grew for so long. So pharma companies, when they came in. So whenever new segments emerge, they have a long runway of growth.
Right.
And obviously investors want to buy that growth at reasonable valuations.
Absolutely.
Right. But the biggest, the conundrum is, or the problem is that when markets start expecting these segments or stocks to grow for long periods of time, how to go about valuing it, right? And invariably what happens is that arithmetically, if the market or you start believing that the runway of growth is very long, then the next few years of profit growth is far less important.
Right.
What is more important is the length of the runway of growth. So when you arrive at a valuation of that stock or sector, what you have to really take a call on is how long the growth path will last. Whether it's a 2-3 years growth story or a 10-20 year growth story. Because what happens is that when you do the valuation of that stock or sector, 70, 80 or even in some cases even 85% of the valuation will not be determined by your assumptions of the next few years.
Right.
It will be determined by your assumptions of the longer term growth rate and the length of the growth runway. So this value of the longer term profits, which is profits after 5 or 8 years,
Right.
and then the growth rate that you assume after that
Mm-hmm.
is the terminal value.
Right.
So invariably high growth sectors and stocks where the runway of growth is long tend to have high terminal value. Right? So we are looking at stocks which have high terminal value, which means we want stocks and segments where the length of runway is long.
Right. Right.
And this is where the concept of gorilla comes in. You know? Because gorillas have certain characteristics. Gorillas, first of all, are rare to find because there are very few gorillas. There are thousands of monkeys or millions of monkeys, but gorillas, they really have to go deep in the jungle to find them. So they are rare to find. Second is gorillas, when they grow, they become large and dominant in the jungle.
Right.
So smaller monkeys don't mess around with the gorillas, they stay away. They become large and dominant. And third is gorillas have the longest life amongst all the monkeys.
Okay.
Okay. So this actually reflects the characteristics of high terminal value companies, which is they are rare to find, right? But when they grow for so long, they become large and dominant in their fields,
Right.
in their respective segments or sectors. And third is they have a long runway of growth, long longevity of growth. So that's why we call these companies gorillas. That's where the whole concept of terminal value investing
So basically, a gorilla is a leader in its own segment.
is absolutely because it grows
Yeah.
at high rates for long periods of time. So they become large and dominant in their segment.
And when we say long periods of time, it could be 25, 30 years plus.
Absolutely. Anything more than 8, 10, 15 years is, really good long runway.
Okay. And typically, they are expected to grow higher than the GDP growth.
Absolutely.
Right.
Absolutely.
Okay.
So, for example, in our portfolios, of course, we have consensus estimates for 2 to 4 years.
Right.
But it's a representation of what we are looking at. Is, for example, our portfolio weighted average growth rate expected for the next few years, it will be closer to 25%.
Oh, okay.
Right? Or even 30% in the small cap.
Whereas we are talking of sort of a 7-8% growth for the economy over the next 20 years.
Absolutely. Or a 10-11% nominal GDP growth.
Right. Great. What excites you most about India's opportunities over the next decade? I won't say next decade, next 2 decades. Viksit Bharat.
Absolutely. So, first of all, I think India is on the cusp of I would say a long growth curve, and that's because of all the structural things that we have done, right? And more importantly, I think increasingly the demographics are in our favor. Though recently there are some articles talking about the demographic cliff for India also, but that's 20-30 years down the line, right? So we still have a good runway of 20 to 30 years where we'll have superior demographics versus the rest of the world. And the world is short of consumers. The world is going to run short of producers also, right? So that is one of the biggest things that we have in our favor. And second is, our energy dependence, our import dependence on that has reduced over a period of time. So while the absolute amount of energy imports is stagnant, the GDP is growing in size. So as a percentage of GDP,
It's coming down.
our external dependencies are going down. So I think what we have seen in the last 1-2 years in terms of FII outflows, etc., is a temporary phenomenon, and the world cannot ignore India. And as we speak, our relative valuations, our relative performance, our relative position in the market cap of the world is, I think, at absolutely low levels, abysmally low levels, so to say, because of the AI hype that got created.
Right.
So as I speak, both from the economic growth point of view and from the market point of view, I feel very positive for India for the next 5 to 10 years.
And I suppose if you compare with any of the market, I think KOSPI was in focus. But looking at the broad base India has, I don't think any of the emerging market really has that sort of a broad base.
Oh, absolutely. Right now, the emerging market index is basically 4 stocks.
Right.
Exactly. The entire performance in the emerging market index has come because of 4 Korean and Taiwanese stocks,
Absolutely.
so to say, and a little bit of China. So I think that's not sustainable. Of course, not to take away from the fact that these are good, really world-beating companies.
Right.
But the kind of growth that we've seen in profits because of the AI traction is something which is not sustainable.
Right.
Because ultimately, if it's chips, semiconductors, RAM, etc., they are still commodities, right? And we always valued them as commodity stocks. It's just that suddenly there is an increasing demand for that commodity, which is leading to a short-term spike in profits. Maybe it lasts for a couple of more years. But ultimately, they are commodities, and production of any commodity can be ramped up and will be ramped up where there's a price signal. So they'll also normalize, and I think India will come back to its normal, rightful place in the world.
So any themes or sectors which you think has the potential to create the next generation of market leaders
For India?
for India?
So essentially, we are looking at three broad themes in India, which I think is a function of all the mega trends that India is into, like we just discussed. First is linked to demographics and income levels and savings, which is premium item consumption, whether it's goods or services, will grow at a faster rate, right? So in services, you have, say, travel and tourism, airlines, hotels, those kind of names will grow faster for sure. Within goods, you have gems and jewelry, liquor consumption, or premium bikes or premium cars. Everything which is premium, premium housing is growing at a rate which is faster than the rest of the economy. So that's premium consumption of goods and services. Second in demographics is financialization of savings.
Right.
So all the segments, lenders of course will do well. They have to do well when GDP grows. But segments catering to savings will do even better. So that's all your ecosystem of capital markets, insurance companies, asset management, wealth management, broking, and for example, depositories, etc. They will grow structurally faster, I would say.
Okay.
So that's on the demographics side. Second is physical assets, right? So India is perennially and will remain perennially short of anything which is physical. So whether it is, manufacturing capacity, whether it's infrastructure, whether it's, real estate, everything to do with physical assets, we are always short of. And given the way we want to grow, including the thrust on manufacturing, this will, I think, grow much faster. And the government is also focusing on that. So that means capital goods, construction, within, capital goods and construction, and the government focus areas like defense, renewables, power, T&D. In real estate, of course, you have premium real estate companies. So all those segments will grow faster, including, for example, airports, ports. Those segments will grow faster than the rest of the GDP. So that's on the physical asset.
Along with that, all the ancillary sectors.
Absolutely, absolutely, capital goods, etc. And third is digital, the digital theme. So we are basically, as you know, terminal value investors, and we see that all these new age companies across, whether it's B2B or B2C kind of models, or even technological link models, they have a long runway of growth. And the TAM is very large. It's a shift from offline to online in a lot of the cases. So these companies, most of the new age companies have a long runway of growth, and that's what excites us. So that's the third digitization theme that we are talking about.
Okay. So this more or less covers, I think, about 75% of our market cap.
No, it doesn't actually, because financial, for example, is the largest segment.
Right.
Within that, we are talking about the capital markets linked or the savings linked segment. Lenders, of course, will do well, but these will do far better. Capital goods actually, in terms of market cap, is a small segment. If you look at the broader analysis, IT services, for example, is 10-15%. That's in my view a low growth segment. Commodities, again, energy commodities, maybe another 10-15%. Those are also not high growth segments. So these are actually, you can generate quite a lot of alpha by focusing on these segments.
And the other large one is the consumption story.
Consumption. FMCG again is a low growth segment. Within that, we are talking about the discretionary part.
Okay, fine. Now, many investors are worried about valuations, and you often spoken about gap, growth at reasonable price. How should they think about valuations versus growth in the current times?
Sure. So this is again a topic which we debate a lot. My view is that people confuse value with valuation. Okay, and in my mind, there is no conflict between growth and valuation.
Okay,
right? Because if you are buying a stock, you want to buy it cheap, right? But what does cheap mean? People tend to kind of narrowly focus on, say, high dividend yield, low price to book, low PE, and call it cheap. In my view, it has to be cheap versus its own intrinsic value, right? And that intrinsic value has to take into account whether, and the point is whether you do it or not, whether you like it or not. The market is going to give it a valuation which is appropriate to its own growth prospects. Right? So you need to figure out the growth prospects of the company. You need to give a proper valuation based on that growth assumption. For example, in our case, the terminal valuation, etc. And then see, based on these assumptions of long-term growth, etc., whether the stock is available cheaper than that intrinsic value.
Right.
The point is that in a market like India, where so many segments and such segments will have a long runway of growth, the terminal value will be very high. And when the terminal value is high, if you compare the PE ratio simplistically for the next couple of years or even 3 years down the line, it will always look expensive because 70-80% of the valuation is coming from back-ended profits, right?
Right.
So, sticking to one or two measures of valuation is also harmful, I would say, and one needs to look at it holistically and not mechanically, I would say.
Okay.
So, for example, one of the measures, very crude measures, could be instead of using a simple PE, use a PE to G ratio, right? So that can take care of some of the future growth aspects, at least for the next 2 to 3 years, and then you can figure it out. But again, that's also a very crude way of looking at it because again, when you have high terminal value, the PE will be high. So PEG ratio also probably may look expensive. So there's no other choice but to take a longer term view.
So in a nutshell, one really needs to look at growth.
One needs to look at the exercise of, one needs to do the exercise of valuing that growth.
Right.
And that's not a simplistic exercise.
Do you think we are entering a more sustainable phase for equities after this valuation reset which you saw?
Absolutely. So as we just discussed, in absolute terms, India versus its own history is now trading at a average valuation. Again, looking purely at a price to earnings or price to book ratio, if you look at the 10-year average, we are pretty much at that average level.
You were at the peak in 24.
We are absolutely. September 24 was the peak, and since there we have price correction, we had a time correction, and earnings have grown. So we are at the average. So that froth is gone. But the real kicker is India versus other markets. India versus other markets in terms of valuations is at a -2 sigma kind of a situation. We've never been so cheap versus other emerging markets and global markets in the last 20 years.
Last 20 years?
Yes. So relative valuations of India versus other markets are actually at a very low level. And that's what gives us the comfort that at some point in time, even the FIs will realize that and they will come.
Yeah, but I think FIs possibly are waiting for the rupee to stabilize.
Which the RBI has, kind of done a good job.
Yes.
Estimates range from anywhere between $30 to $80 billion of that income. And that's a good chunk.
That's huge.
Yeah,
that's anything between 5 to 10% of our reserves.
Absolutely. Yeah. Absolutely.
What are the biggest risks investors should monitor over the next 12 to 24 months?
In the short term, of course, if this AI frenzy continues, which I doubt it will, today we have the SpaceX IPO and the next few days will determine how it pans out. But if the AI froth continues, then we still might have India in the ignored list of markets.
Right.
But otherwise, India should start, because of the valuations, etc., that we discussed. India should start getting its own, share of FI flows. And domestic flows have been extremely strong, resilient.
Yeah.
So there's no problem of domestic flows. Is the minus of the FIs which was dragging the markets. Once even the minus becomes zero and hopefully positive, then I think we are in for a good run.
Yeah, because I think it's nearly 2 years of underperformance.
Absolutely, underperformance and negative flows.
Right. Now tell me, what separates a good company from a great investment? Because I think a lot of people confuse between these two.
I think a great investment needs to be a good company, but a good company need not be a great investment.
Yeah.
Right. If you buy it at the wrong price.
Right.
So,
if I can take a name, possibly something like a ITC or a HUL, good company.
Or some of the tech companies, the best of the tech companies, if you had bought them at the peak of 2000, you would not have broken even for the next 15-20 years.
Exactly.
So, the vice versa need not be true. But to have a great investment, it needs to be a good company to start with.
Yeah, absolutely. So, what are the first 3 things you look at when you are evaluating a business?
So, the first 10 things is the promoter. 1 to 10 is promoter and management in terms of integrity, execution, etc. So, management and promoter is the key. Second is the size of the opportunity. Right? And third is the intangible or the moat that the company has, right?
Okay.
So once these three things fall in place, you have a good chance of having a winner in your hands.
So this is a good recipe for a good investment.
Absolutely.
Okay. And how do you balance growth with valuation discipline?
As I said, we are growth investors, which means earnings growth. We are looking at, for us, the starting point is not valuations. For us, the starting point is growth. And then we test that growth for valuation, whether it's cheap or not. So once we, do the projection, longer term expectations, etc., arrive at some kind of a broad valuation of the company, then we test it whether it's cheap at the current market price. So in my mind, growth comes first because you buy stocks for earnings growth. You buy stocks for capital appreciation.
Yeah.
Frankly, not so much for dividend yields, right? So growth comes first. Arrive at a proper valuation. And if you do that exercise, there is no conflict between growth and valuations.
Okay. And do you think alpha is becoming harder to generate in today's information-rich market? I mean, everyone has all sorts of information.
Absolutely. So the debate, I think the house is divided. In my mind also, I'm divided. For example, if you're a trader, then probably your edge is reducing, right? Because you have high frequency trading algorithms working with, sophisticated collocated circuits.
Right.
You just can't beat them. So if you're a trader, I think you're losing your edge. But as an investor, what's happening is that there is so much money flowing into passives. That index versus non-index stocks, there is becoming a larger and larger gap.
Okay.
Right. Even in India, for example, if you see, though it's not linked to active versus passive, but FIIs own large caps. Right. And there's been a lot of selling in the large caps. So large caps have actually underperformed mid caps and small cap because mid caps and small caps have the support of local investors, retail, as well as domestic institutions.
Yeah, exactly. I think what we have seen in the last
exactly
3-4 months.
Almost 2 years now.
Okay.
So you see large and mid caps are holding up, and where there's selling by FIIs, they are getting depressed. Right. And this is again, a lot of the FII money is passive money. So that in my mind is creating opportunities. Right. So information is available to everyone, but active versus passive also is playing a role in this, and that's the situation in the US also. For example, the large caps and the index stocks versus the small caps, there's a huge divergence. In fact, US has become a 7 stock market, the Mag 7, right? Last 3 years, if you look at the US market performance, it's 7 stocks versus the rest of the market.
Right.
That's not sustainable. So I think sometimes information is available, computing power is available, but that stretches valuations and trends to an extreme. So the snapback can be equally sharp. So I don't think a rational investor has lost his edge as long as he has maintained his rationality and patience.
And when we talk of information, when I said information rich, it also means a lot of disinformation, misinformation in the market.
Absolutely.
That possibly also provides an edge to a smart investor.
Absolutely.
Yeah. When we talk multi-baggers, I know you can't say that this is a multi-bagger. It becomes a multi-bagger finally. I mean, a good investment possibly becomes a multi-bagger. But what are the characteristics which define a future multi-bagger?
So we use a framework called LIM, L-I-M, okay, which is leadership, intangibles, and megatrends. Okay. And when these three things come together, that creates a high growth, long runway of high growth, right? Which is what we are looking for in a multi-bagger.
Right.
Multi-bagger has to sustain growth rates for a long period of time. So which is the high terminal value concept. So megatrends, of course, we know all the megatrends like, demographics, democracy, China +1, digitization, all those things, Atmanirbharta, etc. Long-term trends which are not going to change. So that is in India's favor. Then you have intangibles, which is all the IPR, intellectual property, brand equity, a culture that the company has, which creates a moat essentially.
Right.
So that intangible. And then you have the leadership, which is the most important, which is the vision of the promoter, the hunger for growth. For us, hunger for growth is the biggest factor when you look at a promoter or management. Right. So when you have leadership, which is hunger for growth, vision, execution excellence, intangibles, which is your moat, and the tailwinds of the megatrend supporting you, that creates the recipe for a multi-bagger. And that creates a long runway of high growth.
And multi-baggers are basically from mid and small caps.
Typically, yes.
Typically.
Because any stock or segment which needs to sustain growth for 10, 20 years has to start with a
Small.
large opportunity and a small base.
Exactly. But where do you think investors make mistakes in the small and mid cap space? And how do you think they should allocate the capital? Because everyone is chasing multi-baggers. They
Absolutely.
don't find those.
Absolutely. The biggest mistake is chasing price, right?
Mhm.
Without looking at the fundamentals.
Yeah.
So when you chase the price of micro cap based on what the market is saying or what Twitter has said or something like that, you don't know what you're buying, right?
Right.
And typically when you don't know what you're buying, it means that somebody is rigging the market or whatever. So when you compromise on the quality of the investments, the quality of the promoter, you just don't know anything about the background, etc. But just chasing price, that's what creates risk. So not caveat emptor as you
Yeah,
say.
yeah.
When you don't know what you're buying, that's your risk.
And what is the biggest behavioral mistake investors make during corrections?
In my view, the mistakes are made in the bull run, not the correction. It's in the correction you realize your mistakes.
Right. Maybe I'll just modify this a bit.
Right.
Investors sitting on decent amount of cash during a fall.
Right.
What sort of mistakes could he make?
Oh, see, I mean, good for him that he's raised cash. But the point is that when you're looking at stocks, you have to be optimistic.
Yeah.
Right. And you have to capitalize on those opportunities. So biggest mistakes is trying to time the exact bottom.
Right.
Or trying to get it to the last day or last moment and shall put in 100% of my capital. That never works. So I think as long as you have a broad idea of what the bear case or base case is in terms of market valuations or the stock price valuation,
Right.
you should probably stagger it out instead of trying to time it to the last T.
Exactly. Because typically, I think people make that mistake of looking at a 52-week low and thinking that that's the bottom.
No, that's never the bottom.
Exactly.
So that's again,
Hmm.
see again, you need to know what you're buying.
Exactly.
You need to know why it is at a 52-week low.
Yeah. So, I mean, if you were to start your investing career today, going by the sort of experience which you have had for the last 3 decades and more, what do you think you would do differently?
Oh, that's a good one. First of all, I think I should have been much more positive on India.
Mm-hmm.
Okay, and I think one can't be bullish enough on the markets.
Yeah.
Right. When you as a young inexperienced person, when you listen to certain gurus and all, or sounding cautious sounds wise.
Yeah.
Right.
But may not be good for investment.
But may not be good for investments. So that's one of the biggest. I think we should be all more positive when you're an equity investor. And a debt investor, you need to be more conservative. Equity investor needs to be more positive. And obviously, having started with no capital, it would have been nice if I had started earlier in terms of building the stock portfolio. But I had no choice. We had no money at that point in time. So we were building our capital.
Right.
But after having reached a certain level,
because all of us grew up in socialist India.
Absolutely.
I mean, we saw capitalist India much later.
Absolutely. And second is, once you had the certain amount of capital, again, it's all in hindsight, right? The first thing you try to buy when you're not from Bombay is to buy a property.
Yes.
Right? But if you're not bought a property and stayed on rent and invested that money in stocks, the outcome would have been much different.
Yes,
but that's all in hindsight. These are all really emotional decisions. So
absolutely. So now we'll come to rapid fire. Growth or value?
Always growth.
Large cap or mid cap?
I would say mid and small.
Okay. India or global?
75-25.
75 India. Great. One sector you're most optimistic about?
Industrials and capital goods.
And one investing myth that you feel should disappear?
One myth is that you need to be a financial wizard or a genius to make money in stocks. I think that's wrong.
Okay. Because investing in stocks is simple.
It's common sense. It's more about discipline and psychology rather than anything else.
Exactly. One habit every investor should build?
Read.
So then I think I should ask you, which is one book every investor should read?
I think my philosophy is that in the markets, to thrive, you need to survive. and that means you need to cut the tail risks in your investing portfolio and your career, whatever you call it. So that's why I think the Black Swan by Taleb, which actually talks a lot about tail risk, etc.,
Right.
is a good book for investors. It's not very simple, but if you can just grasp the concept of tail risk, that's a great thing to have. And second, I mean, if you can add a second one,
Yeah,
is
sure.
one on expectations investing.
Mhm.
Because when we talk about long runway of growth and terminal value, etc., what is there in the stock price, what is inbuilt inherently into the current stock price, is what expectation investing is all about, right?
Yeah,
So that gives you a concept of what the stock market is saying about this stock's prospects as of now at current price.
Okay. No, this book I've not read.
Okay.
I think I'll take that. Show you. So Mihir, thanks for a very insightful discussion, and I'm quite sure this will be helpful for all the viewers who are watching this. Thank you.
Thanks for having me, and it's a privilege to have spoken with you.
We hope today's conversation gave you a deeper understanding of the markets, investment strategies, and what it takes to build lasting wealth. If you found this episode valuable, do share it with someone on the investing journey. We will be back soon with another master. Until then, keep learning and keep investing wisely.